Hello, this is Susan Hayes, the Positive Economist, on the second of a series of videos called InvestingInYouth.com, Introducing Wall Street to the Classroom. The area that I'd like to deal with in this particular video is why bother with the stock market, what is its purpose, and why do people continue to participate in it. Oh well, first of all, let me introduce an idea that your students would be very familiar with, namely a bank. The way a bank operates is that there are people out there who have more money than they need to operate their living expenses on a day-to-day basis. These people would like to put money into something where they could generate a return that is very safe. In this case, they would deposit their money in a bank. On the other hand, there are individuals who need to get funding to expand their business, maybe get a mortgage in order to build a house, or in some way bring consumption from the future into now. These people would need a loan, and they would also approach the bank. So what the bank does is that it redistributes the money from one group or one person to another group or person. Everybody is better off because the depositor is getting an interest on his cash, the borrower is getting the money that he needs, and the bank is making a profit also by paying the depositor a small amount, charging the borrower a big amount, and keeping the difference. So now if you think about it in terms of the stock market, individual A, similarly, has more money than he or she needs in order to operate their daily living expenses. On the other hand, we have company B, who needs money to expand their business, and in this case it's the broker who oversees the transaction. Again, everybody is better off because the investor owns a portion of a company and has their money invested. The broker is making money through overseeing the transaction and exchange of funds, and the company is getting the money that it needs. So this is how and why the stock market actually operates. It has a function and role in society. But why do individuals continue to partake in it? Well, here I show a video of Ronaldo. I show it because I want to explain that in order for a stock to rise, it has to rise in value. That is why participants continue to partake in this. And here is a fairly longer example of how. In the case of Ronaldo, Alex Ferguson bought him for 12.24 million in 2003 and sold him for 80 million in 2008. The difference between the two is 67.76 million. Now, to quantify this in terms of a return, what this actually means is that Ronaldo created a return of 553.36% in 5 years, and this is just the transfer value of him. Now, this is more than 100% per year. But this didn't happen by accident. Indeed, he had to work for this, and Alex Ferguson had to work at building him up for this, because he worked harder, he scored goals, he showed promise and potential, he won lots of awards and drew more attention to himself, he got offered more money and was in higher demand, and this is the reason Ronaldo rose in value. So how can we as individuals get a slice of this action? We can't all buy Ronaldo at those millions of euro and train them. So what we can do is participate by taking smaller chunks of larger companies. Let's take Coca-Cola. Had I bought Coca-Cola in 1962 at $1.95 a share and sold today at $48.47, the difference is $46.52. Now again, I quantify this in terms of a return, which equates to 2,385.64% over the time frame, which is in excess of 50% per year. And in fact, as I speak, Coca-Cola's price is hovering around $55, so the return would actually be higher. And this is the reason why. Well, A, Coca-Cola do market research. They develop Coke. They advertise Coke. They sell millions of bottles per week and take in huge sales and subsequently profit. And the company's overall value goes up as a result. And this is what it looks like on a picture, on a graph, so you can see that Coca-Cola was trading flat, relatively speaking, then it went through a steep rise and has been trading flat for a number of years since, and again has now, if you update the figures, is actually increasing again. Now, another and final issue that I want to deal with in this particular video is the whole issue of indices. How can you measure whether the market is up or down? Now, there are two ways to do it. You can check the performance of hundreds of thousands of companies that make up the shop that I referred to in the last video, or you can take a sample of companies and use these as a benchmark. Personally, me and most people would prefer option B because it's a far more efficient and effective way of doing it. If you think about it, if you were to examine the price of every single stock and then try to equate whether the market is up or down, by the time you'd have your answer on any given day, it would be out of date because the market would probably be closed. So how do we do this? Well, let's take a benchmark in the UK. Maybe take a list of the biggest 100 companies, find the average price of the list, and then this is an example of an index. And then tomorrow, let's do it all again and call this the FTSE 100. FTSE stands for Financial Times Stock Exchange. So tomorrow we take that list of 100 companies and find the average price again. Now bear in mind it's only 100 companies, so we can gather this data very quickly. And therefore what we ask is today's average price higher or lower? If it's bigger, well then the market has moved up. If it's smaller, the market has moved down. And that is how you can detect and decide upon what way the market and its direction actually is pointing. Similarly, we can do the same in the US. Let's make a list of the biggest 500 companies. The bigger the company, the bigger the weight, and get the weighted average price of this list. We'll give this index a name called the S&P 500, S&P standing for Standard & Poor, and go back again tomorrow and do exactly the same. Look at that list of 500 companies, find the weighted average price, and decide, has the market moved up or has it moved down? Now, this is not a perfect system, because when you're dealing with 100 companies in London or you're dealing with 500 companies in the US, there's obviously many more that trade in those markets. But as I say, it's an effective and efficient system. And in Ireland, we use something similar. We call it the ISEC, which is the Irish Stock Equity Overall Index. What I would suggest that you might do with your students for homework is that you might ask them to look at the news tonight and say, has the FTSE 100 moved up or down? Has the S&P 500 moved up or down? Has the ISEC moved up or down? And therefore they will get very used to seeing what the market has done and get used to the terminology around it. And that, ladies and gentlemen, is the second video of investinginyouth.com, introducing Wall Street to the classroom. And I'm Susan Hayes, the Positive Economist.